War is exactly when smart investors get rich. That sounds wrong, right? When headlines are filled with conflict and fear, most people think this is not the time to invest. But historically, this is often exactly when opportunity is created. Whenever conflict starts, markets react fast. Prices drop, volatility increases, and people begin to sell. This happens because investors hate uncertainty more than almost anything else. War creates unknown outcomes, economic risk, and political tension. So money moves quickly out of the market. But this does not mean everything suddenly becomes worthless. Far from it. The numbers tell a surprising story. Since 1926, stocks have returned over 11% during wartime. That's actually higher than the 10% average seen during times of peace. Take World War II. The market actually hit its bottom in mid-1942 when the outcome was still uncertain. From that point until the end of the conflict, the market surged by nearly 90%. During the Korean War, the S&P 500 returned a staggering 18.7% annually. Massive government defense spending and industrial mobilization drove incredible economic growth. The key is understanding the certainty principle. Markets hate the unknown more than bad news. Once a conflict begins, the unknown becomes known. Analysts can finally price in the actual risks. This often leads to a relief rally where the market moves up as the path forward becomes clearer. Of course, not every sector wins. You have to know where the capital's flowing. Defense and energy are the most obvious beneficiaries during times of global tension. Gold often acts as the ultimate safe haven when investors look for stores of value. However, bonds historically struggled during war due to increased debt and rising inflation. In the 1990 Gulf War, markets dipped 20% before recovering within just 6 months. Similarly, in 2003, the S&P 500 gained nearly 27% in the first year of the Iraq invasion. History suggests the best wartime strategy is often to simply do nothing. Trying to time the market's bottom is a trap that most professional investors avoid. On average, markets take only 28 days to return to their pre-event levels after the initial shock. When you zoom out, the long-term trend of human progress and market growth is undeniable. Diversification and emotional discipline are your best shields against geopolitical storms. While headlines scream for your attention, your portfolio rewards your patience. Invest based on data, not fear. History is on the side of the patient investor. Conflict passes, but opportunity persists. Stay focused and stay invested. But here's what most people get wrong. Markets do not drop only because companies are failing. They drop because people are afraid, and fear can push prices lower than real value. Think about it for a moment. Do companies suddenly stop making money, selling products, or growing over time? Usually that's not the case, but the market reacts emotionally in the short term. When people see red numbers, they panic. They sell not because the business changed, but because the price dropped. And when enough people do that, prices fall even further. This creates a gap between price and value, and that gap is where opportunity exists. For example, imagine a strong company that is still making profits, still growing, and still expanding. But because of global fear, its stock drops 20 or 30%. Did the company suddenly become worse, or did people simply become more afraid? This is the difference most people do not understand. Price is what you pay, value is what you get. And in moments of fear, those two can be very far apart. That is why smart investors do not focus on short-term price movements. They focus on long-term value. Because when fear pushes prices down, it often creates the best opportunities. But history tells a different story. If you look at history, you will start to see a pattern. Markets often drop when conflict begins, but they also recover. At the start of uncertainty, people react fast. They sell, they panic, and prices fall quickly. But over time, something interesting happens. Economies adapt, businesses adjust, and life continues. Companies find new ways to operate. Supply chains shift. Demand returns. And slowly, confidence comes back into the market. What felt like a crisis at the beginning becomes just another moment in history, And when confidence returns, prices begin to rise again, sometimes faster than people expect. This is why many investors miss the recovery. They sell during the drop, and then they wait too long to get back in. By the time things feel safe again, the market has already moved. This does not mean every situation is the same. And it does not mean there is no risk, but it does show one important thing. Fear is often temporary, but growth is long-term. And the market tends to reward those who stay patient through uncertainty. And this is where most people fail. Markets do not only react to events, they also react to politics. One statement, one decision, or even one headline can move prices instantly. You can see it happen in real time. A speech comes out and the market moves. News breaks and prices react within seconds. This is because markets are driven by expectations. Not just what is happening today, but what people think will happen next. And politics plays a big role in that. Policies change, decisions get made, and suddenly the outlook shifts. That is why you sometimes see sudden spikes, followed by sudden drops. News creates emotion, and emotion moves the market. But here's the real problem. Most people react emotionally as well. They follow the headlines, they watch the news, and they let fear influence their decisions. When things look good, they feel confident. They buy when prices are already high. When things look bad, they feel scared. They sell when prices are already low, which is often exactly the wrong move. This is where most people lose money. Not because they picked bad investments, but because they reacted at the wrong time. They let short-term emotion override long-term thinking. Smart investors understand something different. They know that fear creates volatility, and volatility creates opportunity. They know that markets move fast in the short term, but much slower in the long term. So instead of reacting to every headline, they stay consistent. They keep investing, even when markets feel uncertain, even when prices are falling, even when the news is negative. They do not try to predict every move. They do not try to time the market perfectly, because they understand that timing is almost impossible. Instead, they focus on staying in the market, because missing the recovery is often worse than experiencing the drop, and that is something most people underestimate. They think they can sell now and buy back later, but when the market starts moving up again, it moves fast, and suddenly they feel like they missed it. So they wait. They wait for another drop, but that drop never comes, and the market keeps going higher. This is why consistency beats timing, every single time. Because over time, the market has always moved forward. Not in a straight line, but in a clear direction, and that direction has always been up. So next time markets drop because of fear, ask yourself this. Are you reacting or are you thinking like an investor? Are you following the crowd or are you following a strategy? Because the difference between panic and patience is often the difference between losing money and building wealth. Conflict passes, but opportunity remains. Stay focused and stay invested. Follow for simple investing insights.